investment grade corporate bonds. So while other people are watching their returns shrink, you can sit back with regular interest payments. But you might want to act fast because your yield is not locked in until you invest. And the good news is it only takes a couple of minutes to sign up at public.com. Lock in a 6% or higher yield with a bond account only at public.com/Chit Chat Stocks. Brought to you by Public Investing, member FINRA and SIPC. As of September 26, 2024, the average annualized yield to worst across the bond account is greater than 6%. Yield to worst is not guaranteed, not an investment recommendation. All investing involves risk. Visit public.com/disclosures/bond-account for more info. Last thing I'll say on that, I just saw that my high yield savings account dropped its interest rate. So when they talk about locking in that interest rate, it is not just an advertisement. It is a true thing, and they built a great product for everyone. All right. Now let's get to the show. Why don't we talk about Berkshire Hathaway Energy first? Does that sound good with you?
Oh yeah, absolutely. I'm always up for talking about Uncle Warren.
Yeah. All right. Here's a quote from Reuters. Berkshire Hathaway will take full ownership of Berkshire Hathaway Energy after Warren Buffett's conglomerate agreed to acquire the 8% it did not already own from the family of late billionaire philanthropist Walter Scott. Other notes I just found kind of with their energy investments / oil investments, they own a full, $16 billion in Occidental Petroleum as an outside stake. And I think they own close to 30% of that stock. They own $18 billion in Chevron, and then they also own the BNSF Railway, which is likely worth, I think estimates say, for about $100 billion. So you have the energy company, you have a huge bets on oil and gas, two of their largest positions, and then you have the railway. What are your thoughts on going into energy, oil and gas, and industrials for Berkshire Hathaway as they take this next step as one of the largest companies in the world and try to deploy that cash pile?
Well, I think a lot of people don't understand what kind of beast Berkshire Energy is under the umbrella of Berkshire Hathaway. I was doing a little research kind of prior on our friend FinChat.io, and they are probably the second or third largest energy producer in the country. They trail Next Era Energy, and I believe it's PG&E in California. But the other ones, they're bigger than Duke Energy, they're bigger than Con Ed, they're bigger than Southern, they're bigger than Excel Energy, which is in Minnesota, my former home state. So it's a big part of their business. And years ago, I did some research trying to find something in the renewable space that would be worthwhile to invest. I'm kind of one of those boring investors that like companies that are profitable. And so it was a challenge to find those kinds of companies, but I found it in Berkshire Hathaway and I already owned it. And I was like, holy God, I just didn't know. It just, Occidental gets a lot of coverage. Chevron gets a lot of coverage. BNSF gets a lot of coverage, but Berkshire Energy does not. I feel like it flies under the radar more so. So I'm super excited to own Berkshire because of that one asset just alone.
Yeah, exactly. And what's interesting, and someone in the comments, Tyler here, asks about it, is the internal valuation they bought this out was actually 50% lower than what Greg Abel, I think, sold at in 2020. So they've had those liabilities with, I think, PG&E and stuff like that, or that's a separate company, but that the similar type things with wildfires and all the insurance, whatever that stuff that hurts utilities. Maybe it's a good buying opportunity for Buffett. I think it's interesting that he's doing this right when it seems like electricity demand is soaring because of the AI boom, the data center boom, the semiconductors returning to America with all these factories that are getting invested in. And besides that, you have the natural gas investments with Occidental Petroleum and Chevron, also, generally just petroleum investments. I think that makes sense along with the electricity demand boom. And then you have the railway, which, if we're talking about reshoring, that seems like a good asset to have as well. I guess, when you talk about Buffett and Berkshire Hathaway, you always come away with saying, well, yeah, they're probably making a smart move, and they're probably making I know this term's overused, but an anti-fragile move. Because when I look at the energy stuff, the railway, and the oil and gas investments, it's almost a hedge versus some of the other stuff that might get impacted by commodity prices increasing or inflation going up.
Yeah, for sure. And I've been talking a lot with John Rotanti about how to invest in energy because I have felt for a few years that the growing demand for energy is just going to continue to skyrocket, and it just seems like it's a really hard place to try to invest, especially if you're a typical, if you're depending on what kind of investor you are. And again, I'm more the boring, not necessarily air quote value investor, but I like companies that have some stability and some profitability. And it's harder to find those companies. And it feels like you're making early bets on something like First Solar or Enphase, for example, when you compare those to the utilities, which those kind of leave you cold when you look at the financials of those or just the future growth prospects of those companies. It makes you feel like, where do I turn for all this demand for the data centers, the AI, the chips, and all the stuff? And that's one of the things that I like about Berkshire. And I think Warren was way ahead of the curve again with getting into natural gas and getting into wind and solar and doing it profitably.
Yeah, I agree. We have a question here. Do you guys think nat gas, so natural gas, where will be where the energy demand for data centers will be met as opposed to nuclear? Well, we've seen the talks around a nuclear renaissance. People
Mhm.
are less opposed to it as they used to be. I think there was the big mention from Larry Ellison on a conference call. He's very good at being a salesman. I think that thesis makes sense that nuclear is going to happen, but these projects take 5 to 10 years to build. So at least for the next 5 years, there isn't that pipeline. And people talk about the small modular reactors. I know there's a couple of stocks around that were kind of hyped up a few years ago. Again, that's even a longer term time horizon. So the regulation around that's so high. I think at least for the next 5 years, you have the energy demand coming from existing sources. You know, which is basically natural gas for these energy things, along with I don't have the exact. I'm no renewable energy expert, but the renewables I think are about 20% if you exclude
Mhm.
nuclear in the United
Yep.
States. So small point, but the majority is going to be these traditional sources. All right. Well, I don't know if here's a question for you, Dave. I don't know if you have an answer to it, but does Dave have any opinions on carbon capture storage? It seems like Buffett likes it via Occidental Petroleum. What do you think?
To be honest with you, I have not done much research on that in particular. Um, it would be something that I would probably be interested in looking into if not to follow Buffett, but at least to use what he's doing as a potential launching pad to learn more about it. I wouldn't necessarily buy Occidental just because he's buying it. Oil, oil in particular is way beyond my scope. It's way outside of my circle of competence. Utilities, no, not utilities, but commodities in particular are above my pay grade. So, but the carbon capture, what little I've read about it and seen from different studies and things I've done, it looks really intriguing, and I think it'll be interesting to see kind of how it plays out.
Yeah, I agree. And it's nice that it could be within a larger position where you're not betting on a company that's solely trying to build out this product, where you have Occidental
Mhm.
Petroleum, their existing businesses generate a lot of cash flow. We have another comment that says regarding energy, seems like oil and gas is really cheap. I don't invest in anything energy related, though. I couldn't have said it better myself. I don't like to focus on that. I do think that oil and gas could be cheap. We've seen talks of people saying
Mhm.
that oil could go back down to $50 a barrel, and who knows whether that will happen. It could be cheap in that regards, but
Right.
there's so many different inputs into it. Yeah,
Mhm.
what happens if we get a nuclear renaissance? What happens if electric vehicles take over and that part of the supply chain kind of gets broken for them and the supply goes up and you have OPEC making all these decisions? It's in the too hard pile. I think it is for Dave
Way
as
too
well.
hard. Way too hard pile. Another company that's kind of outside of the Berkshire umbrella is Brookfield Asset Management or Brookfield Management. I'm still going to call it BAMS, force a habit, but that company has done a great job of buying a lot of resources and a lot of assets to kind of help transition and move people towards renewables, in particular hydro in Canada and in Brazil. And so that's a big reason why I've been a big fan of that company as well.
Yeah, they made some very smart decisions within
Mhm.
that market. All right, next topic. we have your first new news item. And I didn't know this happened. So why don't you give some info for the listeners? The credit upgrade in Brazil, potential impacts for some of the investor favorites like Nubank.
Yeah. So recently, Reuters reported that Brazil has received a credit upgrade from Moody's. So they are now BA1, which is, for those of you unaware of the kind of the ratings, they're basically the highest level of junk bonds that you can receive. So it doesn't sound great, but the country was downgraded, I believe it was 16 years ago. And so this is the first upgrade they've had in 16 years. And so it's one level below the, investment grade level bonds. And really what that tells us is that the country is seeing an upswing in their GDP and their overall economic growth. They've gone through their own, I guess, political turmoil with their recent election a few years ago. And so far, it looks like the not new guy, but the return guy is starting to turn things around with the company. And so I keep saying country. And so Moody's decided that they would upgrade them. Now, how does this impact anybody that's investing in some place like Brazil? What it does is it helps push down the cost of capital or the potential cost for any investments in a country like Brazil. They run a lot higher rates than we do here in the United States, and so the risk of investing there is it's higher. And when you're talking about a country with a below investment grade level bond, debt, their debt is running around 78% of their GDP, which is less than ours, but it is growing. And that is a concern from some analysts. But when you're investing in a company like Nubank or Mercado Libre, which is based in Argentina, but they also operate very heavily in Brazil, that can have a big impact on your investments. And so that's why something like this it can be a big deal.
Yeah, and for someone like Nubank, I don't know exactly. I'm no expert on the company, but I think they operate in Brazil and Argentina.
Yes. Well,
That can be helpful. Yeah.
they're in Brazil, Colombia, and Mexico.
Oh, okay. So not Argentina. Maybe that's
Not yet.
smart
Yeah.
because of that
Well,
hyperinflation. So
yeah.
if that gets solved, I guess they might enter that market. But yeah, I I think obviously that's a good thing for Brazil.
Mhm.
It's one of the largest markets down there. It has so much potential. Them and Argentina have so much potential, just given the population figures and what we'll call maybe historical mismanagement or maybe
Mhm.
just bad luck, however you want to describe it. Either way, I guess I haven't focused much on that market. I've focused a lot more on Mexico and a little bit of Colombia, just
Mhm.
because Mexico specifically seems a bit more understandable for me, given its closer relationship to the US market. But
Mhm.
if Brazil stocks have similar earnings ratios, seem similarly cheap, and US stocks of equivalent levels are much more expensive, or you don't find that opportunity over there, like,
Mhm.
yeah, I mean, Brazil stocks would be attractive, but it would definitely have to be something that's trading at maybe 5 to 10 times earnings. That's not one of those, like, excluding the Mercado Libres and the new banks of the world that are
Mhm.
almost are listed in the US and seem to be run by a lot of, uh, how do I say it? It's almost like a Silicon Valley company.
Right.
Whereas the local ones I might want to trade at, 5 to 7 times earnings, where 15 times earnings might seem wildly expensive. But I don't know. Do you invest any internationally
Oh yeah.
or yeah?
Yeah. Absolutely. I own both Nubank and Mercado Libre. My fiance is Brazilian, and I am
Nice.
attempting to learn Portuguese. And I was lucky enough to go with her about a year and a half ago to visit her family in southern Brazil, and it was very telling. First of all, the Mercado Libre or the Mercado Pago payment terminals were everywhere.
Really?
And the purple card, which is Nubank's card, was also everywhere. And her cousin works for one of the local banks in the city that she lives in or is from. And I was talking to him a little bit about Nubank, and he said that it was a beast of a bank. And he said if he didn't work if he had the opportunity for work for them, he would. It just, and the other thing that's interesting is when you go to Brazil, it's a it's a developed country, but it's kind of not. And so certain things about it, like they've embraced technology way more than we have here in the United States. For example, uh, everybody pays on their cards or on their phones. They use their cards on their phones to pay for everything. And so we were at the beach one day, and this guy pulled up with a coconut cart selling coconuts on the beach. And the only way he would accept the payment was with a card on your phone. You couldn't hand him a debit card, and you couldn't hand him cash. And so, and that's the way all these people were coming up. And they would basically just walk up to the terminal, blink their phone on there, make the payment, and walk away. And I was like, oh, that's brilliant. Why don't we have that here? And so I was blown away. So when I got home, I did a whole lot of research and a whole lot of reading, and I was like, yeah, I'm going to buy Nubank. So
Nice, nice. Yeah, and if we look at, I guess I didn't pull up Nubank. This is Mercado Libre. When some of these companies that, I guess I don't want to call it the Silicon Valley bug, but
mm,
they have a characteristics of a really well-run technology company. They can do
mhm,
phenomenally well in Latin America, just given there are a lot of people down there. The countries are much more developed than people think, as you just mentioned, and the propensity to use mobile devices even more than the United States or Canada or Western Europe or other Western markets. If you look at this revenue from Mercado Libre, it has not slowed down
at all.
whatsoever. 2014 revenue of 556 million, last 12 months $17 billion. I think that's in USD. Yep. Yeah, in USD. And that's even with big foreign exchange headwinds in places like Argentina.
Mhm.
44% compound annual growth rate since 2014, which is basically, I think, maybe a little over 10 years. Quite impressive. Quite impressive.
Yeah, for
And
sure.
we have another question on a different market that might even have cheaper stocks. Seen a few pitches around there, and that's Argentina. Tyler asked, does Dave have any thoughts on Argentina? Uh, I guess, yeah.
I
Yeah.
To be honest with you, no. At this point, I have stayed away from Argentina, simply because of the economic conditions there have been not great. The new president that has taken charge, it sounds like he's starting to turn things around, but I think it's still really early innings in some of those things. And so I guess I have chosen to stay away. And you know, the fact that Nubank has not is expanding into Colombia and Mexico tells me that Argentina is not there yet. I think if that Argentinian market was open to a company like Nubank, they'd be there in like 2.5 seconds. But I think because it's not quite there yet, to me, that just means that, I need to kind of bide my time.
Right. Yeah. They're almost saying, look, we're neighbors with Argentina, but Colombia and Mexico look much more attractive to us. Yeah, I think that's maybe a positive for their management team too, that
Mhm.
is smartly looking at Mexico and Colombia that are fast growing. Any what else attracts you to Nubank? Is it just the execution, the competitive set? Are they in like an innovator's dilemma? I could see them definitely being an innovator's dilemma company on the right side of the innovator's dilemma. What
Mhm.
excites you about them? Why do you think they're winning?
Um, I think it's a multifold, I guess, approach. So number one, the the incumbent banks that they're competing against are dinosaurs, and to open a bank account in Brazil, it's like it's probably 4 or 5 times level harder than is here in the United States. Here, you walk into Wells Fargo, you show them your ID, you can walk out of the bank in half an hour, maybe with a checking account, a savings account open, and a debit card ordered for you. Your online banking. There, sometimes you have to make 2 or 3 appointments and come back several days later just to open the account. And a big reason why Nubank started the way they started was because the owner, David Velez, he went through that whole experience when he moved to Brazil to try to open a bank on his own. So they get that they need to make it easier. Number two, Brazil, they caught Brazil at the right time. Most of the country is much poorer than the United States. And so people's first computers are their phones, and for many of them, and the cell phone has exploded in Latin America and particularly in Brazil. And because of that, Nubank has enabled their features. They're a mobile bank. They don't have branches. And so it's just a lot easier to do all your business on your phone. And they were able to capture a lot of that. They also offered credit to people that were never offered credit, never had bank accounts before, and offered them credit. And something that's a little different in Brazil, and I'll try to get this done quickly, but when they use credit there, when you go to the grocery store, for example, traditionally Brazilians would pay on credit. So they would go to their local grocery store, they would buy something, and then it would be put on a tab. And then 2 or 3 weeks later, they would get a bill, and then they would pay that bill. And it was a revolving credit. Now, Nubank is doing the exact same thing with their credit cards. So when you open a credit card in Brazil, or a card in with Nubank, they if you have $100 in your checking account, they may give you $20 of credit. And as you use that credit and pay it off, they'll build the credit up gradually. It's kind of like a secured credit card here in the United States, but they're doing it without having the deposit. And so it's just a revolutionary way to offer credit and make money easier for Brazilians than it was in the past. And it's just those kinds of things. Plus, their technology is just light years ahead. Again, I had my fiance open an account just so I could see what it was like to open an account with Nubank, because I can't. I'm not a Brazilian citizen, and it was super, super simple. Like, it rivaled something here in the United States. And so those things in the execution to me are big reasons why I like it.
Yeah, and that's so important for me when looking at an international stock. If it can change on whatever market you're in. Like if you live in Poland, you'd have great anecdotal evidence and boots on the ground research for Polish companies, but you wouldn't know much about the ones that are only in the United States. For me, for something like this, seeing that, boots on the ground when you visited Brazil, you see that new banks everywhere and people are using it. And then you had someone open an account and it was seamless. And you can see here for this chart here of from our friends at FinChat.io, I should say, use our link, finchat.io/chitchat. Get these KPIs for, they're so useful, stuff like this. When we look at this chart here, active customers, December 2017 of 3 million. The last 12 months, 104.5 million, growing at 73% over this time frame. That's insane growth. And what's great about it is in Latin America, I don't know what the total population of Mexico, Colombia, and Brazil is, but there's still really a lot of room to run here just within those three markets. They're quite populated. And again, go check out finchat.io/chitchat. Get 15% off any paid plan. Go check them out. But yeah, Nubank, super fascinating. I think honestly, didn't one of the Buffett lieutenants bought that, or was that a different Latin America fintech?
No. Well, they bought two. They bought Nubank, and they bought Stone, which is a payments company.
Stone. I remember Stone Co.
Mm.
Luckily I didn't buy it. I lost a little money, or I would have lost a little money, but
Oh yeah, right, for sure. It's crazy. It's trading at like a 7 or 8 PE now. So it's
really?
actually, yeah, it's very profitable. 50-60% gross margins, 15-20% net income margins. It's the financials are doing great, but it's just when you look at a stock chart, it's like, ooh, it's ugly because it got a huge run up, and then during the pandemic, and then like a lot of them lost 70-80% of its value.
Wow. All right. Maybe something to watch or research over here at Chit Chat Stocks. Stone Co.
Yeah,
Forgotten. Yeah, I remember looking.
another one I'll throw out there for that is Pog Seguro. So that's another one that's trading roughly the same price range, same PE levels, profitability and everything. So another great payment company.
All right. You want to talk Nike?
Yeah, let's talk Nike.
All right. I got a few notes here. Earnings yesterday. Luckily, they blessed us with a off-season earnings, so we can talk about something before earnings season starts in about 2 weeks, I think, from this recording. But yeah, it was a pretty simple quarter. Revenue declined by 10%. I think that was kind of in line with expectations since they've been struggling so much. All geographies had declining sales, including the way they break it out is China, and then other Asia Pacific, Europe, I think like EMEA, and then North America and South America. I can't remember. Maybe they separate out Latin America. Either way, all geographies had declining sales. Operating margin keeps slipping. Trailing PE. Now, this is potentially on depressed earnings. So you can kind of look at this glass half full or glass half empty. It's still only at 24. So it's not as cheap as you might think, given that they've had this huge drawdown. But the company keeps buying back stock. They're bringing in a new CEO. They got the old one out, who was kind of a mercenary that came in as from like a consulting type role to come in. But now they brought in a new person who has been with Nike ever since he was an intern. That's probably a positive sign. Seems to be well loved. There's a lot of positive, writing, people talking about this new CEO. They think he can really help the company make a turnaround. Do you have any interest in Nike after these earnings?
Nope.
Yeah, me neither.
Nope.
Me neither.
No, too hard pile for me. Anything related to fashion, footwear, any of those kinds of things. It's just if you see how I dress on an average daily basis, you would understand why I'm saying that. It's just very, very low on my priority list, and I have zero skills when it comes to that kind of stuff.
I do as well. I also, as a reminder, we have a rule at Chit Chat Stocks that is potentially, I don't know if we would ever break it, but it's never invest in apparel companies. They are impossible. We have a question here, though, from Tyler. I think it's a good one. At current valuations, would you rather own Lululemon or Nike? Let me pull up on FinChat the old PE for Lulu here, which I think actually might be cheaper than Nike, or at least similar. Trailing PE of 20 for Lululemon. I think I got to go with Lululemon, just given smaller, more room to grow market share and the cheaper earnings ratio. But what are your thoughts?
Do I have to pick one of them? Yeah, I probably would agree with you. I probably think that Lululemon has more upside potential than Nike does. And I guess I just feel like that would probably be, if I had to choose one or the other, I would probably go with them.
Yeah, makes sense. And I should be clear, I think you as well. I don't own any of these stocks, and they're nowhere near the top of my watch list just because, and this earnings is an example as well, it's too hard to predict what these companies will do just because it's so finicky on how fashion trends change. I mean, look at Abercrombie and Fitch's stock. Maybe you could have made a bet on that after seeing some traffic growth or something like that, but that's not the bet I'm trying to make. And people are talking about Nike like, oh, okay, the China decrease has been a little bit slower than it was. Maybe it's bottoming there. I have no clue. Like, who knows? Who knows if this is the bottom, or they're going to turn around, or if the brand is going to turn into Under Armour over the next 10 years.
Right.
I have no clue.
No, none whatsoever. And the other thing is that the company, I feel like there's a lot more competition now than there has been, and that is an outsider saying that. So it just feels like there's just more competition, and there's a harder road to get back to where they were, because expectations are going to be higher for something like Nike than they are for Lululemon, because Lululemon is a newer company. Nike's been around forever.
Yeah. And Nike's brand has been rock solid for so many years, but I think I do agree there is slowly more of a competitive push from these upstarts, including you have in running shoes, Hoka, running, but also a bit others. I think it's called On.
Yeah, On brands.
I've seen those before. Yeah. When you see people wearing those, it's kind of hard to say like, okay, look, Nike and Adidas may lock down like the professional sports, the big professional team sports in the United States. And that might lead to, soccer cleat revenue. Well, that's more of Adidas, but, basketball shoe revenue and football cleat revenue. But that's not, the whole business is getting normal people to wear those because the athletes wear them. And I would just be nervous owning this one. And when it, again, the stock doesn't look that cheap. PE of 24. Used to trade at like a PE of 40 back on the peak of the bubble, and that's just not one I want to own.
No, me either. No, too hard pile.
All right, let's do the small cap of the week. Have you ever heard of this company, Gen Restaurant Group.
I am not familiar with them.
All right, well, let's take a look. I haven't really looked at them too much, although I should say, for anyone that's interested in more deep analysis, Paul Serra over at Cedar Grove, who's come on the show before, he's done some deep research on this stock. And the reason I found it is because his report was from our Small Cap of the Week presenting sponsor, Yellow Brick Investing. You can check out Join Yellow Brick / I believe it's Chit Chat. Yes, joinyellowbrick.com/Chit Chat. Let me get a little ad pitch for them for us. I know Dave uses them as well. It is a beautiful, beautiful product. Yellowbrick is an aggregator of the best stock pitches across the internet. They track thousands of blogs, newsletters, fund letters, podcasts, and more. They collect and summarize the best stock pitches and bring them to you in a single place. You can try it for free or upgrade to a paid plan and see investor returns and the latest stock pitches on Yellowbrick. As I said, I used it before. I used it for this segment, and you can try it for yourself. Go to yellowbrick.com/chitchat. Excuse me, that is joinyellowbrick.com/chitchat. The link is in the show notes. All right. Gen Restaurant Group. If we look at the FinChat Copilot, they say it is a company that operates restaurants specializing in various flavored meats from Korean barbecue. I think that's the AI way of saying it's a Korean barbecue restaurant that has an all-you-can-eat style. If anyone that doesn't know, they have the circular tables and they kind of cook it at the table. The company was founded in 2011, based in California, and operates in several states, including California, Arizona, Hawaii, Nevada, New York, and Texas. So West Coast focused, but a little bit of New York as well. Give some financials here. Market cap of just $41 million. Stock is in a 60% drawdown since going public in 2023. $195 million in trailing revenue, growing 12.7% year over year. They have positive operating income, but it's just over break even. So not really that profitable, but I think that's something to dive into further because, they could be investing for growth. The restaurant level margins might be fine. They might be investing in a lot of new stores, stuff like that. One concerning thing I saw was that comp sales decreased by 5.6% last quarter. I think that's something definitely investors should look at. They have 40 restaurants total right now and plans for more growth. Clearly, there's a lot of room for expansion. They have close to $30 million in cash and $135 million in operating lease liabilities. So that makes on the aggregators and places like FinChat, who include the lease liabilities in the enterprise value calculation, that's going to make it seem much more expanded than it actually is. If we look at a price to sales and a price to gross profit, it's trading at a measly 0.2 times sales and 1.2 times gross profit. I don't know if you dabble in micro caps, but does this look interesting to you at all?
So I don't know if you know this about me, but I worked in the restaurant business for 20 some years.
Ooh,
And
okay.
I literally did everything from wash dishes to run the place. And so I am very picky about investing in restaurants. I know how hard it is to make money in the restaurant, and I also know how hard they are to run. And so when I see that the market cap is only 41 million, one of the last restaurants I ran did $5.5 million in revenue a year. And so this tells me that these stores are small, and that I think can be an okay thing. But I wonder, if you're seeing comp sales decreasing 5.6 for the last quarter, does FinChat tell us if that's been a gradual, or is that a one-off that they fell off during the quarter?
I checked and they're too small to have the FinChat KPIs,
Okay.
but I
That's
don't think
okay.
there's too many people looking at them. But I think they've only been public since 2023, and I'm
Right.
assuming it's trended in the wrong direction. But
Hmm.
it's the one huge holdup I'd have because if you look at that, that probably means traffic is going down, and you have to ask
Yes.
why. Like, did they do a densification that where an existing restaurant in an existing market ceded some share to a new restaurant that they opened? I'd
Yep.
like to look for an explanation there because
Hmm.
if that continues, I mean, this could go out of. I don't know the leverage there, as you mentioned. It's really hard to run a restaurant business well.
Mm,
That leverage there can turn in the wrong direction.
very
Maybe
quickly.
given your experience in the industry, what do you think is the best run publicly traded restaurant?
Oh, that's probably a good question. I would say probably the two that spring to mind would be Texas Roadhouse and Chipotle.
Okay. I think most people are aware of Chipotle. At least we've talked about it on the show. But what makes Texas Roadhouse? Why are they so well run?
They've figured out a niche. They figured out a growth strategy that works for them, and they figured out a method of operating that allows them to consistently be profitable. And because they sit kind of between expensive and cheap, and they're more moderate priced. Because of that, that allows them to be a little more flexible, if you will. I hate the word anti-fragile, like you said, it's it's overused, but they tend to be flexible when the economy is not great. So during the pandemic, for example, they ended up actually doing quite well because they were open and they were safe, and people could go and eat there and feel like they were getting an expensive night out without having to spend a lot of money. And the quality of the food is really good, and that's always really, really important. And I just think that those things, like, they kind of built themselves on the kind of the Applebee's model from the 80s and 90s, where they offer really good food for a decent price in a comfortable place. And they've figured out a way to grow without, to your point earlier about saturating, like putting restaurants too close to each other and sabotaging from each other. That's a very real thing. And so they've to me, they've figured out how to do that the right way.
Okay, so it's almost like a little bit higher quality than Applebee's and a little
Yes.
bit different focus, but
Yes.
it's the affordable meal that a family can go out to, or you can go out for a date or something like that.
Yep.
Last question on restaurants, just because I forgot that you have all this experience in the industry. What is the most important KPI? Because we always focus on comp sales and
Mhm.
traffic. Is that the most important thing, or are there other things you're caring about?
Well, the three things I'm caring about is foot traffic, is comp sales, and what kind of margins are they looking at? What are their net margins? Um, the margins will tell you a lot about how well the company slash manager can a keep control of their costs, because when inflation is hitting, it's also hitting the restaurants because they're buying vegetables and meat from local distributors, and sometimes they have control over the cost, sometimes they don't. But how well they manage the waste and theft and price increases will go a long ways towards telling you, if they have those things under control. And if they don't, then you'll see a company slip into negative earnings or kind of fly all over the place as the price of meat, for example, adjusts all over the place. The last restaurant I worked at, we had long-term contracts that we established for the meats and seafoods that we bought, and the produce was local. And so I was bonused as a manager on controlling our food costs. So two of those weren't really in my control unless I raised my prices or did other things to try to control portion sizes. And those were the things I paid attention to. So when I'm looking at companies, I'm looking at comp sales, foot traffic, and also the margins.
Okay, and we have a follow-up from a commenter here that says, "Do you care about store margins or company margins, or maybe
Well,
both?"
yeah, both. I mean, it really depends on what you're investing in. If you're investing in a small business, a local business, I'm looking at obviously the store. But if I'm looking at something like Olive Garden or Texas Roadhouse or McDonald's, then I'm paying attention to the company margins.
Right, because they're already scaled up enough. It's important for maybe an early stage one like Gen
Yep.
Restaurant Group or a
Cava.
Portillo's or Cava even.
Portillo's. Yeah, Portillo's is a good one too.
Yeah. So yeah, that does make sense. Yeah, that restaurant margin can be important, but I've seen some companies also brag about that, and then they
Hmm.
never actually generate real profits. So you got to match that up eventually. I guess
Right.
I lied. We have one more question, a good one from the comments, and I think it'll be a fun one. I have some thoughts on this as well. Does Dave have any thoughts on the general fast food market? It seems like companies such as Jack in the Box are cheap statistically. I'm assuming he's saying the stock, but they have real headwinds because of a price and value mismatch.
Hmm.
What do you think?
Yeah, I totally agree with the question. There is huge headwinds in the fast food market, and it seems like every time you turn around, there's a new fast food restaurant opening in your local neighborhood that's competing against. My daughter lives in Columbia, South Carolina, and I noticed the other day that there were two new restaurants that I had never heard of. I frankly don't remember the names of them, but there were, one was on. They were both on opposite sides of a McDonald's, and they were kind of like a oh gosh, what's the big In and Out burger? They were similar to the In and Out burger kind of style of food, and they're on each side of a McDonald's. And I thought to myself, a that was going to be really hard for the restaurants, the new ones, and also it's going to be hard for McDonald's because people are naturally going to go try something different. And I think that if they can't capitalize on it, then I just think to me, fast food is really, really hard place to try to invest. I mean, McDonald's is a different beast because it's been around for so long and it's a very established brand. But some of the other ones, what's the other burger joint that's in New York? I'm blanking on the name of it now. But I think those
Shake
are,
Shack.
yeah, Shake Shack. To me, I mean, it's a great concept and whatnot, but that's a hard way to make money because you got to
That one,
make it.
yeah, Shake Shack. We have a comment that says Five Guys. I feel like those are much harder, especially because you're
Yeah,
going to be way more expensive on a per meal
yeah.
basis than the yeah, the McDonald's or Burger Kings of the world. And I think what also would concern me about fast food and why I think it's a lot different than it was a couple decades ago is
Mhm.
the price taking these companies have implemented, where it's not the dollar menu anymore. You might be spending
Mm-mm.
$10 at McDonald's, and the difference between that and a Chipotle, and why I think the Chipotles, the Cabas of the world, are succeeding so much, is that price gap is really not that big anymore.
Right.
And people go, well, I can get higher quality food for not that much more.
Right. Exactly. And we're seeing an impact from the rising of prices. You're also seeing the impact of rising of payroll for
Hmm.
companies. When I was the last restaurant I was working in, we were having to pay 15, 16, $17 an hour for kitchen people, where a few years before that it was 11 or 12 because the fast food restaurants in the area were paying that. And so to be competitive, we had to do the same. And I'm not saying those people weren't worth it. They certainly were, but it just makes it harder. It's harder to make. You either have to raise your prices or you have to take a hit on the margins.
I agree. I agree. Tough business. And one that comes to mind that, given their input costs are so cheap, can weather the storm is a Domino's,
Yeah.
where bread, tomatoes, flour, all whatever cheese, those ingredients don't change in price that
Hmm.
much, especially the basic ingredients. And there's a reason why they do so well. All right. We have some other topics that I think can be fun. But first, I want to hit our sponsor again, public.com. You heard at the beginning of the episode that interest rates are falling, but you can still lock in a 6% or higher yield with a diversified portfolio of high yield and investment grade corporate bonds on public.com. You might want to act fast because your yield isn't locked in until the time of purchase, and lock in a 6% or higher yield with a bond account only at public.com/chit chat stocks. Again, brought to you by Public Investing Member FINRA plus SIPC. The full disclosure we talked about at the beginning as well. And I'll mention, again, the interest rates are falling and the Fed is saying, we're going to cut rates, and that high yield savings account, it's not going to pay that much anymore. If you're saving, and the perfect thing for this is if you don't want to put money in the stock market because you have a 3 to 5 year time horizon and you're looking to save money for a down payment or something like that for a house, you want something that's going to have a consistent return in that. And then it's the bond account at public.com. All right. That's enough for the advertisers. Do you want to talk the port strike? I know we had a question on Twitter on that. Did you see that this is happening?
I did. Yeah, actually, I didn't know about it until I saw you tweet about it, and you made a comment about the. I don't remember the exact numbers, but you were talking about how much they were getting paid in relation to what they were striking for. I thought that was kind of interesting.
Yeah, what was the number? I think it was specifically in New York City and New Jersey, so the cost of living there is higher, but I think it
Hmm.
was half or more of these workers at the docks make 150K a year. And I was thinking that's pretty good. Not bad.
Not bad.
But yeah, so the port workers on the East Coast went on strike. I think it goes all the way from New Orleans up to Maine. So basically, the Gulf of Mexico and the Eastern Seaboard. They are asking for a 77% raise over 6 years, and they already rejected a 50% wage increase over 6 years offer. What do you think here? Could be inflationary. I know this is kind of just macro stuff and it's kind of a
Right.
fun news item, but it seems like this could cause another supply chain crunch
Yeah.
if they don't resolve it soon.
Yeah. I think there's no question that it will cause a supply chain crunch. It's I don't know if they did this on purpose, but it's wise for them. I mean, it gives them a lot of leverage to do this right before the holidays, so that puts extra pressure on the businesses as well
Good
as
point.
us, the consumers. And you would think that would put more pressure on the companies running the docks to give to give in, or at least figure out some way that they could negotiate a better outcome for both sides. I don't think there's any question that's if it does continue for a long period of time. I saw in the news today, every day that there's a strike, it puts supply chains a week behind, and it costs the
Really?
economy $5 billion.
Wow. That's even worse than the Boeing one, where we've
Right.
talked about the Boeing strike on a couple
Mhm.
of episodes here. And that's costing them, I think, $500 million a week. And
Mhm.
again, could be inflationary because they're not getting that stuff out to market, which they were already struggling with to begin with. But airlines, can't get the planes that they want and they have on that backlog. I think looking at these pay raise increases, and we do have a funny comment that said, should I take a longshoreman position over my private equity offer? And hey, maybe you should. Maybe it's a good offer if they get this raise. That's not a bad gig. So we look at that 77% over 6 years. That's what they're asking. They are going to get at least 50% over 6 years because that's what they already rejected. And they can come back to if they want. Boeing's asking for, I think, 40% over 4 years, so kind of a similar number on a per year increase. I feel like, you mentioned the supply chain stuff, and that could impact some businesses, especially retailers in the United States in the short term. But I think over the long term, the biggest concern from an investor perspective, and look, again, this could be good for society if people are making more money, but from an investor perspective, that wage inflation, that could be it's not necessarily scary, but it's something that can really entrench inflation at a higher rate that we haven't seen for multiple decades.
Yeah, totally. It will totally feedback loop into the system. When we were just talking about restaurants, and that's something that you're seeing from restaurants. When you go to McDonald's now, you can't get a Happy Meal for less than $5 or $6. You can't, there is no dollar meals on the menu anymore. And it's because those price increases for the employees are filtering back into what the customer is paying. And so we're paying more. Dinner for two at McDonald's is $22, $23 now here in the Southeast. And that's unheard of a few years ago. So when you think about this with the port strike, I think that will definitely feed back into, like you're saying, the companies, as they're bringing in products across the world and are selling them to us. They're paying more, so they're gonna have to pass that on to us.
Yeah, here's another incentive it gives out. I think it's a 77% increase on the incentive for automation
Oh boy.
because it makes that
Yeah.
return on invested capital much more attractive.
Hmm.
Just as an example for the listeners, I think Boeing is a much more specific one where the longshoreman is a broad one that can affect everything throughout the US economy. But Boeing specifically, okay, let's say they get this raise. It's a 50% raise. Let's say just in general, and it's not going to be as extreme. Boeing's entire costs go up by 50%.
Hmm.
Well, then in order to make money, they have to sell their planes at 50% higher prices, which means the airlines have to sell you a ticket at a 50% higher cost. So it might be right that these people deserve that pay raise, but there is going to be an impact inflationary on the industry that they are selling into.
Right. Yeah. Yeah.
All right, let's see. Speaking of Boeing, we got a question here that says, any thoughts on the potential Boeing credit downgrade and equity raise? And I saw that while you were talking, Dave, so I looked it up. Didn't see it until I looked it up on Google here. It says Boeing is considering raising at least $10 billion in an equity sale. Bloomberg News is reporting. I think that could be a good idea. The stock is not totally hammered. I know they probably should have done this a while ago, but if you look at their balance sheet, you look at the strike, you look at, I think, given their repurchase history, the shares outstanding are down by half from like 15 to 20 years ago. I think this is a smart move to shore up your balance sheet, because if you get on the right footing, you'll make this money back. You'll be able to return capital to shareholders, but I don't know. And maybe if I was the government and I had this power, I would say, look, before we give you any bailout money, you got to raise equity yourself. And I don't know. Seems smart to me, but what do you think? Do you follow Boeing at all, or is it?
No more than hearing you guys talk about it. It's not a company I invest in, and it's kind of in my too hard pile. But I agree with you. The equity raise, especially if there is a consideration that they could get a downgrade in credit, that would make it harder and more expensive for them to do any sort of money raise. And if they have the ability to do the equity raise instead of using debt, I think that's probably a good way for them to go at the moment, especially if they've been able to reduce their share count by almost half. I think it's probably a smart way to go about doing it. I mean, either way, I'm not investing in this company any way, shape, or form. But for them for them to stay alive, I think that's probably the best way for them to do it.
Yeah, Ryan and I talk about them a good amount, especially recently, just because there's been so much news around them and it's interesting. But I think it maybe is unproductive because there's nowhere, not any scenario where we're buying this stock anytime soon. We do have one question here, and then maybe we can hit any of your other topics before we get out of here. There was the GoGo and Stratcom acquisition. It's almost a merger, but GoGo is swallowing Stratcom. I think people are asking this because I did a stock research report on GoGo that was put out, I think, this spring. Either way, you can go listen to that full episode. I think it still applies to the business today. It's an interesting acquisition. I think there are a few concerns around it, given like why they're acquiring a geostationary orbit satellite internet provider when they thought or were claiming that they're going to put these companies out of business. On the other hand, they're not actually, I think, from reading the Stratcom stuff, all their details and all how the business works. And it's only been a day or two, so I can't really say I'm an expert on the company yet. But I don't think they actually own the satellites. They're just a reseller, and it's almost a way to get a global relationship from a sales perspective to the plane OEMs, the manufacturers, and getting their products, getting their equipment within these planes, because that's one of the biggest hurdles for satellite internet on business jets is just, okay, do you have the equipment in or not? We don't want our plane down. So that's the rationale for the acquisition. I think they also apparently got them for an extremely cheap price because I get, all right, that's not bad. We'll see what happens, but I'm in a big TBD mode. We'll see what people say. We'll see what the numbers look like. We'll see if the business, if the transaction closes. But thought I'd just give a quick update there because people were asking about it. All right. Did you have anything else, Dave, before we get out of here? Got about 5 minutes left.
Yeah, I wanted to give you and Ryan a victory lap for Spotify.
All right.
In investing, my business partner Andrew and I have talked about this many times. Investing is kind of a lonely gig, and people on social media usually just see you either have to brag yourself about how well you do, or if you talk about how you don't do well, then everybody piles on and you're an idiot for buying Uber. What were you thinking? So I know you guys won't pat yourself on the back, so I wanted to give you guys a pat on the back because I know you both invested at Spotify and you've done well with that investment, and you've held it through the hard times when it wasn't doing well and there was lots of negativity about the company. And so I just wanted to give you guys a kudos for that.
Appreciate it. And I will say we do, neither of us owns it today, so we haven't felt the full returns, unfortunately, because the stock, I think, is approaching all-time highs. They've had I don't know if it's an AI narrative. I really don't know why the stock is ripping, but it's been a long time or a lot of gains since that's below $100 a share, that's $75, $80 a share they were at. And yeah, the business has, it's a classic example of how price drives sentiment, because
Yes.
I don't think the business model has changed that much over the last few years.
Mm-mm.
But a couple of years ago, when it was at $80 a share, the pessimism was crazy, and you had to have some. It's not too cheap, but hey, for people that are holding on, I think they should be able to keep growing. I would say.
Yeah, I agree.
All right. Before we close out, why don't you tell the listeners, and I think you are going to be on next week as well, so hit them up with any questions. We did have a comment that said they want a restaurant overview on what makes a good restaurant, so maybe we could do that as a segment. Could be fun. Sure. But yeah, before we get out of here, tell us about IFB Investing for Beginners and where people can find more of your work.
Okay. Well, thanks. You can find us on any podcast player, whether it's Apple, Spotify, wherever it's Investing for Beginners podcast. And we have about 480 episodes. So there's probably one or two that could work for you if you want. And I'm also very active on Twitter. You can follow me at IFB_podcast. And we're also on YouTube as well, and Investing for Beginners. So those are 3 places if you want to learn more about us and see if there's things we can help you with. Check us out.
All right, beautiful. Hit a lot of stuff today. Hope everyone enjoyed it. Make sure to follow us on Twitter and give us any questions for any of the topics you want to talk on, for any of us to talk on for future Investing Power Hours. These go live Wednesday, 1:30 p.m. Eastern Time, 10:30 a.m. Pacific Time on the Chit Chat Stocks Podcast YouTube channel. And you can listen to any of the replays on YouTube, Spotify, Apple Podcasts, wherever you get your podcasts. So whatever method you choose, we don't care. We just hope you enjoy listening. Let me hit the disclosure. We are not financial advisors. Anything we say on this show is not formal advice or recommendation. Ryan, I, or Dave, or any podcast guest may hold securities discussed in this podcast. They've held them in the past and may buy, sell, or hold them in the future. Thank you, everyone, for tuning in, and we'll see you next time.